All right, welcome everybody. Good afternoon. It is that time again. Live at 5 Tuesday, Pharus Global, 1859 Southeast Port St. Lucie Boulevard in Port St. Lucie, Florida. Come on down. We got coffee and even sometimes donuts. How about that? You could find everything that we do at pharusglobal.com, and we like to say that we can help businesses from the cradle all the way to the grave, and some people would prefer exit strategy, so we can help them with that as well. So my name is Brian Hartman, and I am the Vice President of Pharus Group, President of Pharus Funding Partners, and I could go on and on. We have a few different companies under one roof. Today is episode number 22, and we are featuring Shaun Eck. Shaun is the managing partner and co-founder of Ceres Wealth. He has worked as an advisor for some of the top wealth management firms in the country, including Morgan Stanley and Merrill Lynch. Prior to becoming a wealth advisor, he was a managing member of a real estate consulting firm, right up our alley. We love that. Among Shaun's clientele were local and national real estate developers, a foreign oil company, and alumni of the National Football League. Yes, you heard that right. And we're gonna dive into that a little bit too. As a business owner working for business owners, Shaun has a unique perspective that allows him to help clients with complex financial situations manage their wealth and mitigate risk while driving results through a decision-making hierarchy, responsible use of leverage, and effective investment process. And today, our topic is going to be the intersection of business ownership and risk. And without further ado, let's us have a warm welcome for Mr. Shaun Eck.
Hey, Brian. I am well. I didn't get my coffee and donuts, so everyone else gets coffee and donuts but me.
Hey, they're working on that Zoom thing where we could pass it right through, but which way is it? This way? Well, sooner rather than later, I guarantee you we're going to get there. So.
All right, I'm over
it. For everybody that is watching today, whether you're on Facebook or LinkedIn or YouTube, drop us a comment and we'll be happy to answer any questions or say hello to you, or just give us a shout. We'll be happy to talk to you. So Shaun, we're happy to have you here today, man. And just for everybody out there, tell us where you're located and what the temperature is today.
Yeah, well, we're a little bit more Floridian today than normal, but I am in the northwest suburbs of Chicago in Barrington, Illinois, and we're at about 67 today. That's wow. A little exciting, but we're going to be back in the 40s this weekend, so it was a short-lived visit to Floridian temperatures.
Well, at least there's no white stuff in the forecast, right?
No, that's all melted, and so it's just rain moving forward, hopefully.
Awesome. Glad to hear it. So we're getting out of football season and actually coming to baseball season for you guys, huh? Is that the weather we're looking at?
That's right. So, and look, my son was born April 10th of 2007 in a blizzard. So we're definitely not out of the woods.
I remember in 1 year in April, the Yankees opening day got snowed out. And of course I had tickets for it. So
yeah,
that opening day.
Break out your mittens and your hat, right?
Yeah, no doubt. Sometimes you got to do what you got to do, right?
Right. New York.
So we're
tough.
excited, man. We're excited to have you here today. I know we're going to talk about a lot of good stuff. It's the first time that we're having a wealth manager on the show, so excited about that. And you guys do things a lot differently than some of your typical wealth management firms out there. So can't wait to dig in. So with that said, let's roll right in. What differentiates a business owner from other Ceres clients that you work with?
Yeah, I mean, obviously that's the foundational question here today, right? So being in real estate and moving into wealth advisory or wealth management, I have a little bit of a different perspective than most, especially who have spent their whole career in wealth management. And I think I understand risk from a little bit of a different perspective. But I was fortunate that early in my wealth management career, I came across a book by individual Moshe Milevsky, who is a finance professor, I believe, at the University of Toronto. And the name of the book was, Are You a Stock or a Bond? And there's really two things that this tapped into. One answers your question, one doesn't, but they're both worth talking about. The first one that doesn't answer your question he was talking about was the difference between human and financial capital. So human capital is our earning potential, right? So the day that we graduate college and have our first job, or the day we start our business, we'll never have more human capital than we do that day. That's our earning potential. And there's a glide path where we then transition into accumulating financial capital, which is just a fancy word for money, right? And so theoretically, you're the poorest you are on day one in financial capital, but the richest you'll ever be in human capital. And then theoretically, the day that you exit your business, the day you retire, whatever that day is, right, that you have the most financial capital, that's the wealthiest you'll ever be in your life, right? So we're trading human capital for financial capital. So I think that's something that's very important for people to understand. But to answer your question, what really separates people, and this which gets into Moshe's title of his book, Are You a Stock or a Bond, is looking at the connection between someone's source of income, and in this case, it's their investments. But as we'll get into a little bit later, I look at it as their overall balance sheet if you're a business owner, right? But we'll simplify this and keep this in the investment conversation. So Moshe uses his situation, being a tenured professor at a university, as very stable or safe income. I believe he even makes the comment that he'd have to do something pretty horrible in order to be fired, right? So he knows from year to year what he's going to make. So he should have an inverse relationship with his income source and with his portfolio. So he uses the example, he's actually 130% invested in stocks, meaning that he's likely using a margin account and buying using leverage because his income source is so stable. Right? Now, I wouldn't recommend people do that necessarily. It works for him. That's fine. I'm not his financial advisor. So the flip side of that, though, is the business owner, right? And so with a business owner, you have a unpredictable income stream coming from your business, or at least most of us do. Okay. And so when you look at that unpredictability or that volatility in your income source, that means you have to have some stability in your balance sheet or your investment portfolio. Right. And so it's important to draw that connection, to look at yourself as an asset and to make sure that your financial capital works in conjunction with your income source.
Makes sense. I know that business owners tend to always be juggling where their money goes. And do you find that in a lot of cases, business owners save the savings for last?
Well, what I find with business owners is they tend to like tangible assets. Okay, so which means their money is usually tied up in things that are illiquid. And so what I find with a lot of business owners is they're asset rich and cash poor. And so these are some of the things that we need to look at with them, is to make sure they don't wind up in that situation, because then you need to try and liquidate things at a time where maybe it's not advantageous to do so, or there's a high cost in doing so.
Yeah, makes sense. So how does Ceres define risk for their clients?
Yeah, so this is one of my favorite things about the wealth management industry, and my smile is not one of happiness. We do a horrible job, rather, in our industry of measuring risk or identifying or defining risk for clients. We've tried to simplify it to the point where we've created things like risk tolerance questionnaires, right? Answer these 12 questions and you know how much risk you should be taking. If only it were so simple. Right. And then the other thing is we've created terms in investing like standard deviation and beta to measure risk. And I can tell you, in working with business owners, that risk is not a statistic. The way that we define risk is the impact of your ability to generate cash flow when you need it. Okay. And this goes back to what we were talking about with, are you a stock or a bond? And let's use, because as you mentioned, I do have a real estate background. I understand the asset class of real estate. I understand that it's a good store of value, but it's not very liquid. And so when you look at something like real estate, which might not be, depending on the market that you're in, so I'm going to put a little asterisk next to this statement, that real estate's not an inherently risky asset in itself. The ability to generate cash flow from it can be, right? Because it takes a long time to sell it. Even if you have a buyer on day one, it could come weeks or take weeks just to draw up the contract, just to draw up the paperwork before you get to a closing. Or if you want to take a loan against your real estate to create liquidity, as you know, Brian, that takes some time too. So it's not something that we can create liquidity from in a pinch. And so you can take an asset class that your risk tolerance questionnaire would tell you is not risky, but in actual real life, in all practicality, it is risky because of the lack of ability to generate cash flow from it when you need it.
Makes sense. Over the years, business owners that I've worked with always contemplate using their securities as collateral to get a line of credit. What is your thought about that? And are they better off liquidating the securities and then maybe throwing it into a CD to secure a line of credit, or should they leave it in the market?
It's a really good question. So in today's, we're jumping ahead a little bit to where I was going to get to, but it's a great segue into this. We're in a really unique environment right now in that all assets are expensive. And so with interest rates being as low as they are, it's forced people up what I call a rung of the ladder of risk, okay? And so what I mean by that is, and this goes back to 2008 when the Fed lowered interest rates to zero, it forced savers into a situation where, right, they say CD investments. CDs are not investments. It's a savings vehicle, right? So it's taking people from being a saver to being an investor, where those people moved into the corporate bond market. And then the people who were in the corporate bond market, because yields came down, were forced to go into dividend-paying stocks. And then the people who are in dividend-paying stocks, because now the dividends are lower, wound up going into growth stocks. And the people who are in growth stocks went to the Moshe Milevsky School of Investing, are now 130%, right? Now that they're investing with leverage. So it's forced everybody up a rung of that ladder of risk. So in that particular situation, where I'm looking at interest rates and saying, well, they're essentially zero if you're opening a CD or putting in a money market, whatever the case may be. So maybe we keep it in that portfolio, but we buffer that portfolio for risk. So we make sure it's not 100% stocks, manage out some of that volatility. And while they don't offer a lot of upside, maybe we bring in some bonds into the portfolio just to create some stability, which is going to present two opportunities. One is that the bank that's lending to you is going to provide you more leverage on your money because you are taking less risk in your portfolio. And then two, you're going to have less volatility in your portfolio as well, while it's being leveraged for something else. So I would definitely stay in the market, but I would buffer the risk in that portfolio to help manage the fact that we're really advanced and stretched when it comes to valuations. But stocks right now are kind of the prettiest girl in the room of not so pretty girls.
Great comment. I like it. So you mentioned how Ceres define risk for your clients. How should a business owner think about risk?
Yeah, so this is one thing where we really differentiate ourselves in how we engage with business owners. So going back to the balance sheet, at the root of who we are, we're a balance sheet advisory firm, right? So what we're doing, and again, because I come from real estate, my job in real estate was, for lack of a better way to describe it, was put people in debt, okay? And so hopefully it was productive debt that they're managing properly. But at the end of the day, that's what I did, right? So when you look at that, I understood the liability side of the balance sheet before I understood the asset side of the balance sheet. And so that's why I say, coming into this industry, I've seen it from a different perspective. And so I know the impact that we can have as advisors in providing people advice on the liability side of the balance sheet, just as impactful, if not more impactful, than what we can be in helping them on the asset side of the balance sheet. So we're going to go through each one of those line items on that balance sheet and provide them advice in the grand scheme of who they are financially and who they want to be financially and what they're working towards. So what that parlays into, what we use is what we call the wealth allocation framework. Okay, and the wealth allocation framework takes your balance sheet and splits it up into three different categories. One is, and we just say it's buckets, and a lot of people use this bucket system, and we have a third bucket that's kind of a differentiator. The first bucket's your safe bucket, right? So that's the money that's going to, as a business owner, that's going to be used to meet your short-term needs or your emergency needs, right? Your second is going to be your market-based bucket. That could be, to your point, that could be securities, it could be real estate. There's a lot of things that could be part of that market-based bucket. That's going to be the assets or the liabilities that help a client keep pace or outpace inflation, right? That's not going to happen in the safe bucket because right now, especially right now, you're not going to earn anything on that money. But that's okay. It's opportunity cost. We need it to be liquid. This other money, right, we're looking to get some return here. So that's, we're getting in some different categories there. And then the third one is your aspirational bucket. So let's say you have, and actually let me take a step back. I have a lot of clients who are angel investors, okay? But that's not their day job, right? They run their business, let's say. I've got one client on top of my head who's a tech CEO. He owns 2 different companies, but he's a angel investor and loves doing it. And so the conversation I have to have with a client like that is, okay, we've got our aspirational bucket, all this money that you're putting into these different companies that if they work out is going to move you up to the next level of wealth, which is what we're setting out to do. That's why you're making these bets. But if it doesn't work out, we need to make sure that you're safe in your market-based buckets are significant enough that it's going to put you in a position to maintain your lifestyle. And that could be a personal lifestyle, or that the business lifestyle is meeting payroll and just maintaining the daily operations. Right. So we need to make sure so that those bets or those risks that we're taking don't put those foundational fundamental things that's day-to-day life as a business owner at risk.
So basically the third bucket is, if it goes on fire, it's not going to be the end of the world. But at the same time, if it goes on fire in a positive way, it could turn your whole life into a whole different category.
Absolutely, right? So that's where that aspirational term comes from. This is what, turns a 100,000-aire into a millionaire, turns a millionaire into a multimillionaire, and turns a multimillionaire into a centimillionaire or potentially a billionaire.
That's awesome.
Yeah.
It's a nice way of saying funny money, basically.
Yeah, I mean, or, FU money. That's a term that I like to use. I think that resonates with a lot of people.
Yeah, I think they can understand that. So then the question becomes, when business owners are thinking about risk, should they avoid going into debt to avoid risk?
Yeah, I mean, obviously with what you do, Brian, with Pharus, that's a great topic for you and I to discuss. But there's a difference between good debt and bad debt, right? And let's look at someone's personal balance sheet to lay out an example of bad debt. So if you're going to go buy a car that has high mileage on it and put a 5-year note on that, probably not a good idea, because maybe the shelf life of that car is 2 or 3 years. So we don't want to take an asset that A, is going to be depreciating, and B, has a short shelf life, and finance it beyond its shelf life, because now we wind up having to replace it and we still owe money on it. And that's, as we all know, that's going to be a destructive financial situation. But there's good debt too. Think about a business owner. If I want to take out a loan to hire somebody because I have too many sales or I have too much pent up demand for whatever my product is, and I need someone else to get out there and sell it, or I need someone to run the administration, the operations, or whatever it is, if hiring that person is going to unlock new revenues for my business, well, I think that's a pretty good investment to turn around and have that arbitrage of what I'm paying to the bank and what I'm making in return. And the beautiful thing about owning a business is your return is usually not 10%, 20%. There's usually an X after that, right? It's a 5X return. It's a 10X return. And so when we're talking about returns like that, then I certainly feel that that substantiates going to the bank and asking them for money, especially with how cheap it is today.
It was something that we talked about earlier today, that the toughest part of getting that ROI, or that 10X, 15X, whatever it is having to put out the money to begin with to get there, right?
Yeah, it is. I shared a personal example of that with you, Brian, and it's one of those things where even though you know it's the right thing to do, sometimes it takes some steel nerves to actually do it.
Yeah.
I
had a client just today that was going through that in her her mind also. She's trying to grow a business, doing very well at it, but the question came up, she's currently running it out of her house, doing very well, but growing out of her house. Basically, she needs to get her house back, and it's growing quickly. And what was holding her back was the thought of having to pay rent for a space to be able to move the business into. And then I said, I know it's difficult because you're adding an expense, but how much more revenue are you going to bring in because of it?
Right.
And then like this big smile came on her face, and it was like, oh yeah, that makes sense now. I feel a little bit better. And
it takes money. It takes money to make money, right? And that's we've all heard that saying, but it's we lose sight of those fundamental foundational sayings when we're emotionally involved and it's our own money.
Yeah, absolutely. Yeah, and it's true. It's easier to tell somebody else what to do with their money than it is to do it yourself with your own.
That's right. That's right.
So yeah, you have to look at what's the long-term effect of it, and keep remembering that when you're writing the check or taking that loan to be able to get to that next level to do.
Well, and the other thing is having an exit strategy, right? If you take on that lease and let's say the business doesn't work out for some reason, you have the ability to sublet it. What are your outs? Maybe you negotiate that. When it comes to a loan, what's the cash flow of my business? If this doesn't work, can I support this? Can I service the debt? And just making sure that we're not being reckless in taking on this debt, but understanding the downside of it, but also understanding the significant upside that it presents.
You almost sound like a bank underwriter. Not that I know anything about that,
Well, when it comes to our portfolio management, these are the types of things that the trade-offs that we have to think about as we're managing investments for our clients. And we're looking at the companies we want to own and we don't.
Right. Yeah, it's funny how that goes, but that's the process. How are they going to repay? What's the backup plan in case they can't? And is there a backup to the backup? Basically, is what they do.
Funny thing about the word loan, it implies repayment.
Oh, you're kidding! Got to do that.
Yeah, these banks are tough like that.
I'll tell you, kind of gets in the way of a lot of things.
A lot of fun.
Yeah. So, let's talk a little bit about strategies. So what strategies does Ceres use to manage risk for their business owners? I think we mentioned the buckets, a little bit of that, but what else?
Yeah, so when you look at strategy, and it's a loaded question because strategy is in context of who the client is. So when it comes to a question like this, it has to be kind of at a 30,000 foot view, just because, when you get granular and there's different variables, we go in different directions. But this question lends itself back to a comment that I made earlier about how expensive all asset classes are right now. So when we look at strategies for clients today, one of the overriding themes is behavior. And what I mean by behavior, I mean asset behavior. Okay. And so let's use the bond market as an example. Let's talk about that safe bucket for people.
Right.
So for your safe money, typically for a client, if we could, let's say we had a need that was a week out and I had time to liquidate something and move the money into a checking account or savings account to satisfy a need, maybe we'd use something like a short duration bond fund, which might yield 3 or 4% historically, but today will yield less than 1%, maybe 0.5%. It doesn't even justify the fee that the fund manager would charge, right? So something like that, where we're looking for safety, we would try and find a product or another asset that would mimic the behavior of that historically and provide them the liquidity that they're looking for. So this is really a challenging environment right now, talking about moving up those rungs of the ladder of risk, just because the things that historically and fundamentally we would do aren't available today. They don't make sense today. They might actually be putting you in harm's way instead of creating safety for you. So it's really understanding the context of who the client is, and then us kind of going back in the laboratory, and figuring out how we're going to mimic the behavior of the asset that we would have historically used to create that safety or the upside for that client that they're looking for to meet whatever goal it is that we're trying to achieve.
Awesome. So just as a reminder to everybody out there, if you have any questions for Shaun, drop them in the comments section. We'll be happy to answer them. Just wave hi and say hi. I know that I saw Jackie out there earlier. She did wave and say hello. So hello to Jackie out there. Shaun is here to answer whatever questions you guys have. So just drop them in the chat. All right, so this has been the question that I've been waiting for. So I know it's a discussion about business owners, and I'd be remiss if I didn't ask you, where do you see the stock market headed from here?
Yes, I left my crystal ball in the other room, so my outlook is a bit murky. But my Swami hat.
Yeah.
So the good news is, this is for business owners, is that the business environment right now is fantastic. And there's no better time in history to be in business and to be looking to grow a business or to start a business. So that's great. And obviously that bodes well for the stock market as well. Now, there's areas of tremendous opportunity and there's areas of a decent amount of risk as well. And I'll cover where the risk is first. So looking at the market capitalization of the S&P 500, the big tech companies, your FANG companies, your Facebook, Apple, Netflix, Google, Amazon, represent 25 or 26% of the market cap of the S&P 500. That's obviously a staggering amount for 5 companies, 6 companies, 5 out of 500 to represent a quarter of the market capitalization.
Right.
So let's look back at 2000. Okay. And yes, the .com bubble, or your pet.com or whatever, who these companies that had these big market caps who had really no tangible value. It was crazy. And this is not what we're dealing with today. So the example that I want to use is actually Cisco. In 2000, Cisco was the most valuable company in the S&P 500, had a market cap of $600 billion. Since then, Cisco's business has actually quadrupled. That's fantastic. The issue is, if you own their shares over that period of time, you only averaged 0.62% a year over the past couple decades, right? I don't think my clients are real happy with me if that's the return that they're getting. So what happened is the share price moved way ahead of the business operations. So let's look at a company like Apple today. So historically, Apple traded at a valuation of 11 to 15 times. And the last time I looked, which I think was last week, and it might have changed since then, although the NASDAQ had a big rally over the past couple of days, was trading at a 33 multiple. So it begs the question, what's changed in Apple's business model to justify that stretch in valuation from 11 to 15 to 33?
Right.
Well, they have moved more towards services, which is going to, moving away from hardware. There's higher margins. So that could justify some expansion in valuation. I don't know that nearly triple is going to be where that should be. So when you look at how far ahead these companies have moved in terms of valuations, I think there's going to be a period of time where the business has to catch up with where the share price is. So we could wind up into, and I don't know how many years it's going to be, but we could wind up in a situation where you have some meager returns that come as a result of tech doing as well as it has, especially over the past year. And then there was a point that I heard recently that I thought was fantastic, talking about tech over COVID, saying, do you think that over the next year, 5 years, 10 years, that tech is going to be used as much as it has over the past year? Well, as the economy starts to open up, and I don't think the economy is going to go back to what it was in terms of the traditional economy and brick and mortar retail and things like that, but there's going to be some reversion to the mean, which is going to take away business from the Amazons, right? I just had 3 boxes show up from Amazon today. It's great. I personally don't like going to brick and mortar, but I'm not like everybody. There are a lot of people who like to go see, touch, feel, smell, whatever it is that they're going to buy. And so those patterns of consumer behavior are going to come back. So when you think about that, you go, okay, I don't know that tech is going to be used to the same level it has over the past year. And then we look at how stretched valuations are. And one of the things that allowed valuations to stretch as far as they did is because inflation has not been present and interest rates have been so low. So now the 10-year treasury yield has come up a little bit. There's so much money out there in the system between the Federal Reserve and stimulus that there's just bound to be inflation as a result of that. And we've been saying this since 2008, but it looks like we're finally in the base case scenario where inflation does start to rear its ugly head again. The Fed's going to start to raise rates, and that's going to impact tech specifically because of their stretched valuation. So there's a case to say that tech's going to struggle. So if you're that guy who owns the S&P 500 index fund and 25% of the market cap is overvalued, there might be time to start looking at a different strategy for your money, because there's plenty of opportunity out there. So that there are pockets, whether it's energy, whether it's real estate in different pockets as offices come back or hotels come back, anything that's consumer discretionary with all the money that's being pressed into the palms of consumers with $1.9 trillion in stimulus. So there's plenty of areas where we're going to see green shoots and opportunity for growth. I just don't know that those mature tech companies are where we're going to want to be allocated to moving forward. So it's definitely something for people to be mindful of. But overall, looking at where we're at from an interest rate perspective, looking where we're at foundationally, because one of the main things that we pay attention to as a firm when we're looking at that risk on, risk off trade, right? Do we want to be overly risky? Do we want to bring some bonds into the portfolio? And you'll love this, Brian, it's credit availability. So if businesses have access to credit, they can fund operations, they can grow, they can invest, they can do so many different things with that money, right? They can do share buybacks. There's a lot of things we can do with that money. So as long as credit availability is there, and with programs like PPP, in addition to banks getting comfortable with lending again, there is plenty of liquidity out in the marketplace to make sure that businesses can do what they want to do. So that is absolutely a great underpinning for the market to go up from here.
Awesome. So with the market being in the state that it is, unfortunately, there's a lot of unemployment happening right now, and has been for obviously the past year. And that probably has a lot of 401k money going with it. You know, a lot of rollovers probably happening. Is it in your recommendation for people like that to use those funds to start up companies of their own? You know, obviously with direct retirement accounts and not having to pay taxes necessarily, but what is your thought about utilizing those funds versus maybe borrowing money to start up the business?
Yeah, that's a really good question. So to me, the best investment is always in yourself, right? I had two young business owners, late 20s, started an IT company. They've done very well. Last year was they were able to both pull $300,000 in income from the company. They had low overhead, and they were looking at coming on as clients, and they did from a planning perspective, but then they were looking at doing investing with me as well. And then they made the decision. They said, you know what, we want to put that money, that expendable income back into the business. And I started laughing. I'm like, I'm not going to argue with you. You guys have done phenomenal. So what I would say, Brian, is as long as that investment is an educated bet, right? If you've been in IT your whole life and now you want to open a doggy daycare, I don't know. We should stick within, stick in our lane, so that if we're going to allocate that money to a business, that I want to know that there's a high probability of return on it, right? Because what we're doing is we're leveraging our retirement in order to start that business. But again, going back to talking about, right, that 5x, 10x return on loans that we're taking and allocating into our business. Mm-hmm. Well, that's what we're looking at with business investment as well, with that retirement account. So someone invests with me and they average 12% a year. They're ecstatic with that. But that's 12%, right? Not 1,200%. Right. So I can't offer people the same returns in their portfolio as they can get investing in their business. I just want to know, again, getting into exit strategy and different things like that, that there's some risk mitigation in place, and you're always thinking about, how do I unwind this if it doesn't work out the right way? So be mindful of what the potential exit is, but absolutely, I'm behind people investing in themselves.
Awesome. So what about if you flip that around a little bit too, to where you have people sitting again with retirement accounts potentially, and you have business owners looking for equity partners. So is that something that is a good idea to utilize those funds, or should they kind of stay on the sidelines with it?
As a portion of them, absolutely. All of them, of course not. You don't want to make concentrated bets like that. But I would also say that, make sure either you understand the industry, or the other thing is to have your CPA go through their books, make sure everything's being run properly, right? So just the same way I would look at a stock that I want to add to a client portfolio, think of that as what you would want to leverage in terms of doing the due diligence as to whether that's a company you want to invest in or not. So make sure you take a proper peek under the hood before you make that investment. Make sure it's not too concentrated of a risk, but absolutely, that's getting into those X returns, right? Those big returns. And coming in as an equity partner provides those opportunities, but let's make sure that we're managing the risk in that scenario as well.
Awesome. Well, we talked about a lot of things with the intersection of business ownership and risk. Shaun, anything else that we didn't cover that you wanted to mention?
I think we've pretty much covered it at this point. I mean, we could certainly do episode 2.0 as we come up with different things and the market takes shape. Maybe we do a market update. Hopefully Shaun was right in that scenario. But we've covered a lot of ground today, and I really appreciate your time and everyone's attention.
Yeah, no, thank you for being with us. So let me just want to make sure everybody gets your contact information. So you can find Shaun's email address and the best way to reach him at the information listed below. That's shaun.eck@cereswealth.com, 847-757-2445. And once again, Shaun, we definitely will be doing a 2.0. There's no question about it. I think maybe we should schedule it maybe 6 months out just to see where we're at this
Sounds
point.
good. I look forward to it.
Thank you very much for being on, my friend. I appreciate it.
Thank you, Brian.
And to everybody that's out there, if you'd like to be on our show, remember Tuesdays live at 5. That's Eastern time. So get on our list, get on our schedule. We're happy to talk about you and your business. Thank you very much for being here, everybody. Have a good night.